right. Hello, everybody, and Happy New Year from us to everyone. I think it's the first Learn It Live for 2020, the new decade, Tyrone. Welcome, and of course, tonight we're going to be looking at how to trade commodities. My name's Thomas Atkinson from FX Evolution, and as always, I'm joined by Tyrone Abella.
Hi everyone, Happy New Year to everyone, and good trading for 2020, the new decade and the new year. And what better way to start learning than to actually look at the commodities that everybody is talking about at the moment. They are all the rage: gold and oil and a few of the other big noters we're going to have a look at tonight. But it's a really good way to get your teeth into trading if you haven't traded already, or if you haven't traded commodities. It's a really good introduction. So we're looking forward to getting into tonight.
Just before we get started, Tyrone, obviously I'd like to go through the risk warning. The information provided in this webinar has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification and should be considered only general in nature. Obviously, seek your own independent personal advice if necessary before making any trading decisions. So what are we going to be covering today, Ty? We're going to be covering a few things. One of them is a beginner's guide to trying to trading commodities. What commodities we'd be looking at if we were getting started, what particular pairs I think probably make the most sense to get started with and why. Also, of course, why gold is a popular commodity. There's more at play when it comes to trading gold than just thinking, oh, well, I'm going to trade this instrument because it's tradable. There's a lot of other things that you need to think about and take into consideration before placing a gold trade. And then, of course, what market conditions for trading we should be looking for and what should we be focusing on when it comes to gold, and then the live Q&A. So if anyone has questions, please feel free to ask those questions throughout the webinar. We may answer them on the fly, or we may try to answer them at the end. And it's always a great experience to answer some great questions because we know that many of you will have the same questions, and answering those and having them in the videos, which we upload to the Pepperstone YouTube channel later tomorrow, allows everybody to go and learn from those in the future. So which trading pairs are the best to start with? Well, I think it's clear that obviously gold is a great one, and it's a very technical trade. The great thing about gold is it's been traded for a very, very long time. In fact, it may be probably one of the longest trades really ever in human history, Ty, when you think about it, because that was one of the original barter metals. So gold, very popular for a very long time, and it has that kind of mystique, and while it may not be used as much potentially in real life products, it's obviously used in jewelry and is used as a hedging metal. So we'll talk about that. But gold versus US dollar, gold versus Australian dollar, and gold versus euro are all actually very technical trades. So we like all three of those pairs, and they're definitely a great place to start. Oil, of course, XTI and XBR, both great oil pairs to get started with. And then probably the lesser metal is silver in terms of the technical trades. Often what will happen on gold is happening on silver. So it's a good one to go and maybe look for technical trades on gold, then switch over to silver and have a look. But I will be warning people, when you're trading silver, it can be a little bit different contract size kind of tie. So you do want to make sure you use contract calculators like the Pepperstone advanced trading tools before placing those trades. What are your opinions on silver, Ty?
Yeah, it's an absolute must that you use the Smart Tools app on the MT5. Have got their own version of it for Pepperstone clients. I believe it's free for people who have got a live account over $500. So definitely get that on your trading platform if you are going to trade silver, because the contract sizes are different and you can be really caught out. And quite often you might think you're doing a certain amount of risk, and it'll be very, very different to what you think it is. So definitely use that calculator until you get familiar with the contract sizes, and then you can go ahead. But it's a great commodity to trade.
I also find that platinum is not a bad technical trade. There's obviously other commodities, but these are just a great place to start, especially if you are a technical trader and especially if you're on the smaller time frames. If I was trading 5-minute, 15-minute, 30-minute charts, gold would be probably my number one on this list. Another thing that's important to know is what times to trade commodities. So it's also important to think about that these commodities, while they are generally always trading, they will close for small periods of time. So here's just a quick timer for the Pepperstone platform and when things close and when things reopen. So a lot of people that are getting into commodities don't realize that there is potentially a time when the market will be closed. And when the market's closed and opens again, there is that slight gapping or change in price that could happen. So always be aware that this can happen when trading commodities, and that's a little bit different to when you're trading, let's say, the Aussie US dollar. That might be open all the time on the Pepperstone platform. Things like commodities, they will close for these like kind of hour, 2 hour periods. So why is gold a popular commodity to trade? Well, one of the main reasons is it's a hedge against inflation. Another reason, and I think probably more importantly when it comes to volatile trading, is it's a hedge against global instability. So when you see things like we saw recently with obviously that stuff in Iran, it did have an effect on gold. And we saw gold spike quite heavily to the buy side because people are starting to hedge against, at that stage, global instability. And that's probably maybe the story of the next decade. If we have global instability, if we have a GFC, we'll have a look at a quick chart a little bit later on and take a look at how gold reacts versus a GFC event. What is going to happen in this instability? We're in a time where we're basically seeing incredibly fast movements in the markets, incredibly quick overreactions, and if we're in, let's say, buy positions in gold and something like this does occur, it actually is a benefit. But if we're in a short against this particular type of instability and it happens while we're in the trade, then of course it will be a massive detriment. So it's important to understand that gold is popular because of that volatility, but at the same time, it's also a risk that you need to think of when you're taking those trades. Portfolio diversification is another one, Ty. I mean, how many people, pretty much every main portfolio out there in super funds generally has some exposure to gold, doesn't it?
It does, yeah, and look, it's a stronghold for a lot of reasons. People do feel comfortable. I think it's a self-fulfilling prophecy in a lot of people's portfolios that they feel they need to have it just so they are hedging themselves against any potential outbreak. Like we just said, you do get world events that affect gold quite significantly, and it is probably one of the commodities now. It's nearly taken over from oil. Oil at one point, we'll talk about this probably a little bit later. But oil did used to spike very, very heavily on any conflict in the Middle East, especially. But that seems to have settled now. It doesn't seem to do it anywhere near as much as gold does. So yeah, it seems to have taken over and probably regained its position as the ultimate hedge, really. And I think it is a self-fulfilling prophecy.
Another thing is it's a speculation of demand for the metals. So a lot of people don't think about when they're trading a particular commodity, let's say gold, there is an inherent kind of worth for that metal. Now, another thing is if you looked at 100 years worth of gold chart, you'll notice that gold, while it has its booms and its kind of busts, it has generally gone up over time with inflation. So it is really more bullish than it is bearish over the long term period. And that's kind of similar to things like indexes. If you're trading the S&P 500, it's generally more bullish than it is bearish over the longer term. And it's important to know when you're trading a pair. It's a super basic concept, but it's often overlooked. There's always that inherent slight bullishness in a pair like gold. Now, but even before we look into the charts tonight, Ty, and we will be looking into the charts, we want to continuously reiterate something that we talk in every single webinar about, and that is the top-down approach. And while even if you're a 15-minute, 5-minute, 1-minute scalper, it's important to understand what is happening on the larger time frames. And the reason that is because that is where the biggest money is traded. That is where the big decisions are made, and generally a daily trend or a weekly trend will have lasting consequences. It will move in that direction. It will be biased to that direction. So getting a bias from the top and then going down and then doing your 15-minute, 1-hour scalps, you'll actually have a slightly higher advantage of success. And that, of course, is very important when it comes to trading. So you need to recognize a trending or range-bound market. We're taking a look at a few different things that have happened on gold and oil over last year, and then of course what could be to come. And of course, using lines, bars, and candle charts. Never fall into the trap of just using one. Everyone starts with candle charts. Some people kind of start with lines. Very few people start with bars. So do bring them all in. There's advantages in every one of them. Specifically, lines and candles, definitely something that you should pay attention to.
Yeah, now look, we've had a couple of questions already about, which direction gold is heading. So look, this is not a technical analysis forecast webinar. So that one we do, FX Evolution does do those, and we do them every Wednesday night. So I'll actually pop in a link for people to jump in and have a look at that. And if you'd like to join us every Wednesday night, you can. But what we will talk about to answer some of these questions is exactly what we're saying now. When you look at the bigger time frame, and Mike, just to answer your question, what would you be doing with gold? Well, it's really important to understand what the bigger time frames are doing, just like Thomas said. So if the overall trend on the daily is long, now that could be because for a number of reasons from a technical standpoint. I mean, the moving averages could be tracking up with price above it, or the last couple of candles from on the daily, and not so much the weekly, because it's not really going to help you on a scalp, but on a daily and 4 hour, if they're positive bullish candles, it does give you a bit of an opportunity to say, okay, we're going to look for scalping opportunities in the interim. If we're going to day trade it or we're just going to scalp it, you want to be trading in the direction of that trend. It's really, really important, because that trend is the one that's likely to hold and dictate what's going to happen in the coming hours. So if you are, for instance, looking at a day trade and you're looking at maybe a 15-minute or a 1 hour chart, the most important time frames that you're going to be wanting to pay attention to and trying to identify which way the trend is actually going is going to be your 4 hour and your daily. They're the ones that are the most significant, especially the 4 hour one for scalping, to tell you what is potentially the next move. Because if the market is in your favor and the momentum is in your favor, it's going to make your trades so much more free flowing. You're not going to have anywhere near the trouble you're going to have if you're trading straight into a very strong headwind.
So how to become an expert quickly? It's what we all want to be, or we want to get to, but how do we get there? So I think, look, I always like to say Warren Buffett's one of the most well-known, of course, investors of all time. He didn't become an expert overnight, and he'll probably self-admit that he's not an expert at everything. He's really great at certain types of investments and probably not as good at other types. So it's better to be great at trading a few pairs than good at trading all markets. I see too many traders, what they do is they come in, they say, okay, I'm going to trade commodities, I'm going to trade the indexes, I'm going to trade gold, all of the different currencies, and then I'm going to expand my currencies to get more trades. Each one of the currencies, while they all might trade very similar technically, or the commodities, they all have little nuances. Certain things move the market. Like we mentioned before, if there's global instability, you will see gold generally spike. It goes up. So if you know that, it's that little bit of the first nuance to trading the commodities. It's very important to be great at trading a few pairs and to hone in on those. I myself am pretty good at things like the yen pairs and the US dollar pairs. It's what Tyron and I chose to be really, focused on at the beginning. Then we got really into indexes, and we trade indexes a lot. And of course, gold was one we added. So we add them as we master previous ones. It's a good kind of lesson to learn. So Ty, let's have a look at some live market examples before we go back to those slides. So here we've got a few different currencies, and we've got the commodities here being gold. So we'll actually load up gold. We'll leave it on our charts. Now, for anyone that doesn't know, we use a 20 moving average of 50 and 200. And we're actually going to go straight to the monthly. And there is a reason we want to go to the monthly. Even if you're trading, let's say, we'll go to the US dollar pair. Let's say we're just trading 5-minute charts. It's still important to have an idea of where gold is compared to where it's been in the past. So one important thing, I'm just going to draw these two quick support and resistance lines. And the reason I want to draw that is because what we can see on this larger time frame is we can see that this was previous support that has acted as resistance. So it's very important. And that we had this really strong resistance here that when it was broken, the market gravitated towards this 15 kind of 50 area. So with gold, generally speaking, things like 50s and 100s mean quite a lot. So if you're hitting let's say 1600 for the first time, or you're hitting 1700 for the first time, or 2000, or any of these things, the market will generally pause on the smaller timeframes. It will act as kind of a price-based resistance, and it may not just break straight through that. It'll actually have a consideration for that, and that's because there's a lot of orders at those levels. So the reason we always draw this is because this is actually a giant ascending triangle, this area here. And when that did break, it was pretty much predicting that it would go the length up to this 1550 area. So by focusing on this monthly chart, seeing this break on, let's say, the weekly, we were able to say at this point here, we're only looking at buy positions for gold, even on our smaller time frames, only looking at buy positions all the way until it hits our resistance. And by doing that, we give ourselves a bias. And when we have that bias, then we can say, okay, we're only looking for buys. And guess what? The momentum of the bigger traders is in our favor. The people hedging, the people that are diversifying their portfolio, they're all in our favor. And it's just so powerful, Ty. I mean, not enough people do it when they're scalping. We didn't do it at the beginning when we did it. It's just, I can't stress how important it is.
Yeah, definitely. And look, just to clarify also, when we talk about bias in this situation, we're talking about a technical bias, okay? So we're not
Yes.
saying, what's your gut feeling about gold or what's your gut feeling about, where oil is going. It's very, very important to have a substantiated reason for what you're going to do. So a technical bias is something that you definitely want in your favor because it really outlines your trade map almost instantly, okay? So what you're basically doing is giving yourself an opportunity to trade with the trend no matter what. So you're taking away a lot of potential bad trades by getting yourself caught up in what may look like a potential move in the wrong direction. Like for experienced traders, once you've done it for a little while, counter trend to your heart's content when you've got a really good plan and you're trading the right time frames and identifying the right patterns. But when you're first starting out, or even for intermediate traders, sometimes it's always easy to swim with the tide, and that's why we say that a lot because it's generally, even us as experienced traders, Thomas and I very rarely counter trade a solid trend. We always try to stick with the easy low hanging fruit, like we like to say, because that's basically what we're trying to achieve. We don't need to. What people find is when they are counter trending, they're almost trying to prove the market wrong. And quite often you do get caught up if your entry points aren't pinpointed perfectly to actually get into your trade. You can get burnt on the downside, and I think that's the difference between the biggest difference between trading with the trend and against it is when you are with the trend, your entry points are a lot more, the market's a lot more forgiving. If you do get them a little bit off skew, generally the momentum of the trend will carry it in your direction anyway. And I think that's probably the key for traders who are just starting out or who have only, been doing it for a little while.
Yeah, one thing with commodity trading, Ty, is that when a trend is on, it can be fast, which we're going to see with oil, and it can be very aggressive. So I've got a question here from Fra, and it says, I see it makes sense, but I thought scalping was not really looking for large moves. What is your stop loss take profit in pips? So look, scalping obviously really means in the essence of scalping is like 5-minute, 1-minute charts. We understand that. But scalping for a lot of people is kind of that day type of trade, all the way down to maybe just being in the trade for less than an hour. So for the purposes of this exercise, what we're going to say is if you're trading in the market, you get that bias on the larger time frames, and it just helps you to know that the bigger traders are with you. So if you see, let's say on a 5-minute or even 15-minute or 1-hour chart, a little bullish hammer down here, let's say, there's a little bullish hammer in this area here, you know that the larger time frame's with you. A lot of trading is about having the confidence in the trade and holding the position. How many people out there have probably closed their positions early because they see it go up in their direction, it comes back down, and then they go, oh, I'm a bit scared, and they take the trade out early. Having confidence is such a key thing. So having that bias is massive when it comes to
That
scalping.
confidence comes with the bias, and when you've done it enough times, you know that you can rely on technical bias. And we trade in the direction, whether we believe it's going long or not. One of our hard and fast rules, and we do manage, quite a bit of money. One of our hard and fast rules is to make sure that regardless of our personal bias, we always trade what we see, and what we see is technical bias. And regardless of what we believe something should be, we always trade in the direction that the technicals are telling us to, because at the end of the day, charts and price action win the day.
So here we've got the gold US dollar tie, and we were looking originally at the monthly. I'll just quickly go to the monthly for 1 second. So we can see here on the left, that support was going to act as resistance. The market then spent a long time thinking about that. Now, it's actually important to even know this on the monthly. If you see a resistance hit and you see it start to think about it, well, guess what? When you're going down to the daily, you can almost lose your bias on whether you're thinking it's long or short, or even have a slight short bias, because it's hit that main take profit area, the people that people are going to be taking on the monthly. And then you can now say, okay, maybe I've got a slightly neutral bias, and you take the buys and the sells. That's what happens when you recognize those bigger time frames. And you can see it was very choppy for quite a long time. Now, what happened over the Christmas break is we saw that volatility spike, we saw global instability potentially happening, and of course, gold spiked all the way through, gapped up here. So you can see the gap that happened, and then of course quickly spiked, came back down, and this level of previous resistance has acted as support. Now, the reason we're highlighting all of these points is because of this candle here. So many of you out there, some people call it a pin bar, some people call it a hammer. Hammer is probably the more technical term for it. Will know that this is very strong signal to the buy side, especially when it's in such a key level. So when you see something like this, you can pretty much, technically say, okay, there's a higher statistical chance that the next candle is going to be a bullish one. And when you know that, guess what? We could be on the 15-minute chart the next day, taking our scalps long. So that's something that you want to consider when you are trading gold.
Most definitely. And look, we've just had a quick question about why that bar is significant. And look, let me quickly explain it for the people who don't understand price action. We'll actually we'll make it a little bit bigger. So what that candle is basically, you can call it is basically a candle, but a bar would look very similar. What we're really looking at there is an open. Here's the bar version of it, and we'll actually highlight the open of that particular bar. So you can see there, that little handle there is the open of that trading period for that day. You can see that the sellers have absolutely tried to push this all the way down. Like, they've had a really red hot go for the whole, for nearly the majority of the session, trying to push that down and make a new low. But in the end, or at some time during that session, the buyers have come in and taken control and basically reversed that entire move of the sellers pushing that down and brought it back up. And as you can see, that the handle here on the right is where it actually closed. And so what that's telling us is the buyers have completely reversed the momentum of the sellers. And what makes that really important is that it's done it at a place of very, very solid support. And we can see that when we go to the bigger charts, you can see that area is where we highlighted, because this is where we expect a role reversal. It was resistance prior, and now we are expecting that place to be a good level of support. So, and that's why it is a very significant candle. That bar in the middle of nowhere doesn't really bear any significance, but when it's in an area of support or resistance or a role reversal area, it is a very, very important bar.
So let's actually break it all the way down, Ty. Let's say, okay, we were coming in yesterday and we had a bias towards the buy side because of what we saw on the daily. Then what we decided was we're going to look for potential price action trading opportunities. Well, here we've got the moving averages, the 200, obviously the 20, the 50, and we can see there's some little bit of volatility coming through at this point. And guess what? Very similar candle tie in the direction of our bias. So it comes off the 200, obviously price has moved up. It's a bit of a short, sharp kind of breakdown that we see here. And then of course, we also know that this point was previous support, resistance, broke through, became the support, acted as support again, but more importantly, we see this nice rejection. So someone was asking before about, I think it was Fry again, was asking, yes, but where's the stop loss, take profit areas? So this is a great example of a perfect kind of candle in the direction of what our daily bias is. We could potentially take this trade. Now, a couple of little tips that I guess we'll bring into this one. If we're trading a hammer candle or a candle confirmation, we don't just want to say, okay, candle's closed, buy. What we want to do is we want to actually put probably about 1 pip or a few little points above and we want to place our order as it breaks through here, because what that does is, as Ty mentioned before, this is a little bit of a war. The market sold off, then it's bought all the way back up and closed at the same point over that 15 minutes. So when it breaks up and closes above here, we can then say, okay, the market is continuing with the momentum. It will save you pips. It will actually save you trades, that kind of idea and concept. Put it a little bit higher, because how many times have you seen a hammer and then the next candle doesn't even go 1 pip above and it just goes all the way back down, breaks out the low? So that actually is very important, that continued momentum. Where we'd place a stop loss here, we'd take the distance of this particular candle, we'd then add a percentage to it, and then that would be below where we'd place our stop loss and take profit very clearly in the resistances. So if we were scalping this type of trade, that is what we'd be doing, and we have that bias. So very, very important to think about it that way, because it really makes a big difference to your trading.
Probably one of the things I want to highlight, Thomas, and a lot of people actually, when they do first start out trading, or when they're starting to explore different elements of the trading platform and say, okay, what are we going to trade? Which different instruments are possible to trade? Commodities can appear sometimes a little bit scary, and so can indices for that matter, because people think that they operate differently. And look, to an extent, the contract sizes are a little bit different, no question about that. But the Smart Tools app will fix that for you, and it makes it basically it's automated really for whatever
Absolutely.
risk you want to put, so you don't have to worry about that. But probably the key that we can probably, the most important key to highlight to everybody out there is that trading commodities and trading indices, or any instrument for that matter, when you're using technical charts, is exactly the same whether you're trading gold, silver, the Euro USD, or the Commonwealth Bank of Australia. It actually makes no difference. Technical analysis is technical analysis. And what that means is that the learning curve isn't as big as people think, because when you trade a particular pattern or a particular setup on any instrument, it actually translates to whichever instrument you're placing it on. So a double bottom, for instance, or a hammer candle setup like we saw there, there's a double bottom that we just we can highlight. The pin bar that we talked about, or the hammer trade, you would trade that the exact same way, whether this was gold or whether it was the Euro USD or the S&P 500. It's always traded exactly the same way. The only thing that changes is obviously the distance and the time frames, but that is relative to the time frame that you're on. Quite often, when we're doing our tutoring with our students, what we often do is actually block out the time frame that we're looking at, and we also block out the instrument, because that can sometimes confuse people, and they think,
Great
well,
point.
I don't really know that. But the point is, what we're trying to highlight is actually it doesn't make any difference. And the thing is, we should be able to put any chart in front of you, and you don't need to know what instrument that is, and you don't need to know what time frame that is to be able to actually trade the technical. So it's really important to just remember, don't be afraid of commodities and don't be afraid of indices, because they trade in the exact same manner. If anything, we sometimes find, especially gold and some of the bigger
Gold's great.
indices, they're actually even more stable than some of the cross pairs. The technicals are even more sound. So you'll actually have a better time trading them than you will on some of the more exotic pairs. There's no question about that.
And remember, open yourself up to those other golds, gold, odd, gold, euro. They can be very technical. They can do slightly different things because they're against a different currency. And again, they give you quite a bit more opportunity, but very similar kind of trades, so you can understand it a little bit easier. I got a couple of questions about support and resistance. How does support become resistance? It's a thing called role reversal. Very important for you to understand that. You can look it up in Google. Obviously, it's in our course as well. We cover it in great detail. But yeah, role reversal is incredibly important to understand when it comes to trading price action. Very, very important.
Yeah, I'm almost certain that we've actually done several webinars on the Pepperstone site that have got a lot of role reversal topics on them and actually showing them. We will highlight one. We'll probably do a role reversal one in the coming weeks as well. But just go through the Pepperstone library and you'll find some stuff on role reversal there, and you can watch the videos that we've done on them. It's a very, very important aspect of trading.
Okay, so chart patterns with commodities. Do they work? And are they important to understand? Absolutely, they do work. I'm going to show you everybody a great example of an inverse head and shoulders that we saw on oil that gave us that bias to go onto the smaller time frames. But things like double bottoms, ascending triangles, flags, and inverse head and shoulders, and double tops, of course. All of these patterns are so great in gold trading and oil trading, specifically even better in gold trading. So if you don't have these in your trading arsenal, go and get better at these, work your craft on these particular patterns, because every single one of these works very, very well and presents quite often on the smaller time frames. Another thing, we want to recognize trends, of course. Now, we've just put here peaks and troughs, and of course, what we require for a long position. Now, we go into this in great detail in other webinars. We're not going to do it today. To a lot of people, it'll just be, they'll look at the weekly, it'll look like it's up. It's important to understand, again, look for those larger time frame patterns, because the patterns are self-fulfilling prophecies. So once you've seen a pattern, I guess, execute and become active, you can see how explosive it can be. So very, very important to recognize those trends. So links to gold trading and volatility. So one thing I always like to do is I like to learn a little bit of what happened in the past, and then I know that this can happen in the future. So of course, we're a long time actually since the GFC now time in 07, 08 kind of area. And what happened to the S&P 500, so the American 500 index, and then of course, what happened to gold during that period of time. So you'll see that gold got very aggressively bought into the back of the GFC, and of course the S&P 500 really sold off. So that's the ultimate hedge at that point in terms of how much appreciation people saw from gold. Then of course the VIX indicator. Now people call the VIX indicator or volatility indicator kind of like the fear index. A lot of people argue it's not. In our cases, whenever the VIX has generally spiked, you have seen gold usually appreciate as well. Generally, that is what happens. So it's important to get a little bit used to looking at VIX indicator if you're going to be a gold trader, and I definitely suggest you have that in your analysis, just so you can see what's happening on the VIX, and that gets you an idea of what's happening. Because if the VIX is high, your scalping or your trading on gold is going to be a lot more aggressive each way, but it may be biased towards the buy side. So important to look at there. So go back to the charts again, Ty, and we're going to have a look at probably XBR, so Brent. Now, the reason I wanted to do this is we've got a quick little line chart over here, and we can also use candles or we can use bars. And what a few people will recognize straight away is this is actually an inverse head and shoulders on the larger time frames. So we've got our left shoulder, our head, our right shoulder. It's always important with these, if the right shoulder is smaller than the left shoulder, then that's excellent, because that means that the market wasn't quite able to get as low as it was on the left shoulder, and that shows that the market has bullish intent. So the market is keen, it is confident that this is really, really good price, and they want to push it in this direction. So the importance of this one on the weekly, again, is to get that bias. What we'll notice is that when the weekly had closed through, which happened on the daily, the confirmation was good enough. It was quite aggressive in terms of moving up. And in terms of the distance that we would recommend, or we would usually say is the take profit on this, it's this distance here. And that distance becomes pretty much the self-fulfilling prophecy. So you can see here, look where it went. Look at the kind of previous supports. It makes a lot of sense. Nice big weekly kind of rejection. That type of weekly rejection is really going to push me to take more shorts on the smaller time frame for the next coming weeks. That's what the market did, and then had that short bias. So if you recognize this, you get in there, you get your bias, and you look for those opportunities, and the big money will help for you to get those longer term trades.
Yeah, and like we've said, I mean, look, we've been, obviously, every webinar that we did, and we did 50 of them last year, gold and oil were at the forefront of nearly every start of the webinar that we talked about. The technicals
So much
for the entire period, for nearly the whole year, were just brilliant. And yeah, it's pretty safe to say, anyone who has been following us will know that a lot of trades were placed in the direction of these bigger time frame trades. So we can't highlight enough how important some of these commodities are. They're just so technical, and yeah, they held up for a whole year, and so far so good this year as well. They've been actually very, very good this year already, so hopefully they will continue. But don't ever be afraid to trade them, because they are very, very technical.
Just wanted to highlight a few things I do know that are here in the middle of kind of a nice little uptrend here in XAU. So gold again versus Aussie with that nice ascending triangle break, the role reversal where resistance becomes support. All of these are opportunities for you to then say, okay, we're in the bullish momentum. Let's take the trades, either these proper trades here on the larger timeframes, or take trades inside of the smaller timeframes in the direction. So it can be daily, it can be weekly, it can be 4 hour. When you get that bias, then you're able to take those trades.
Absolutely. Now, actually, we've just had a question on that triangle actually. So can we just highlight? Let's just quickly highlight that triangle, just so you can see there where we got. Yeah, we'll make it a little bit bigger.
Yep.
Here we go. So this is the triangle that we're talking about, and the retest to the top of that triangle, we'll actually highlight that with a, well, that's the retest that we're talking about. So you can see the initial break just past the 2/3 of the triangle itself. It's gone up, had a crack at going higher, and then it's come back and retested the top of the triangle, which is an absolute, that is the zone that you're praying for if you've actually missed the initial break. And quite often, it's the more conservative way to trade this triangle. Now, the question is, how would you know to get in on that? Would you just trade it? Well, no. And this is exactly what we were talking about earlier. As you can see, this is a daily chart that we're talking about here. But if you take this down to, can we put a yellow highlight square just on that area? Because it's probably a really good exercise to show exactly what we're talking about. I reckon we'll put the yellow square on the current time frame, and then we'll drop it back down to maybe a 1 hour time frame, and we'll go back to that.
I'll put the highlighter on it.
Okay, great.
Yeah.
All right. So what does everybody see there? I mean, this is the area. Now we've gone to a smaller time frame, so we're in the exact same spot where that big candle was sitting. And for the question that came, where would you enter? We'll just head back to it now. MT5 can be just a little bit jittery when it's when we're moving it a bit quick. That's all right.
I'm zooming it for everybody. There we go. All right.
There we go. No. All right. So look at the 1 hour price action. We've got like a little mini double bottom there. We've got the 200 on the 1 hour offering a good level of support. Most importantly, the most important thing about this trade is it's come back and tested the top of the ascending triangle, and that is your entry. You've got multiple entry points that you could have used here. You've got a little bit further down the track, we've also got a moving average crossover, but you should have been well and truly in by then. This pattern broke up, and these are all the little things that you're looking for once you've identified your bias. And this is why it's so important that we were talking about it earlier. When you've got that bias in place, you're only looking for longs, and you're looking for the reason and the price action to justify exactly what it is, the direction that you want to trade. And that's how you basically break it down. Highlight the zone and go to a smaller time frame and look for that change of trend.
Another thing you'll see, and this is the 15-minute time frame, is when you've got those, that kind of area that you're targeting, what you might notice sometimes is you'll notice that the market makes like levels of resistance. So you'll have like maybe 1, 2, or 3 touches where it comes up, hits the resistance, and then breaks through it on the smaller time frames. When you see that coming off a really solid base, that's amazing kind of trading, because what happens is this is showing that the smaller time frames have thought about this level, they've failed to get that resistance kind of break, and then they've gone through. And we talk about double bottoms at these zones, we talk about triple bottoms, we talk about inverse head and shoulders. Even these kind of patterns can happen on the smaller time frames as well at these zones. So very, very important to understand it and then break it down. It's that next level of trading that makes the difference. All right, so what economic conditions or what market conditions do we look for when it comes to trading, I guess, gold? Look, gold actually trades pretty well all time frames now. It used to trade really poorly, I guess, during the Asian period, and then really well into London sessions and American session. I think it trades okay now pretty much all of the time. Specifically, sometimes Asian sessions have really good runs on gold. So it's a good one if you want to kind of trade all of the time. Of course, things like non-farm payrolls, key economic news will affect gold, but not as much. It's more about that global instability that will affect it the most. And of course, Mondays can be also fake out days, and that goes for most of the currency pairs and commodities. So just be careful because not all markets are open, and that's especially true for things like gold. So just always be a little bit careful on Mondays and probably focus more on the Tuesday, Wednesday, Thursday kind of trading days. Type of market conditions, is it in a trend? Has it hit a massive resistance point or support point on the weekly, daily kind of area? If that has happened, is it now becoming range bound and you want to change your strategy for that? And of course, the time of year as well. It's important to note that we haven't really seen this, but if we have a volatile kind of time that generally is happening, maybe we've got things like the US stock market is having earnings season. That can affect gold. If earnings are poor in the US, it may spike gold because people start to think, wow, there could be some volatility here. Maybe the market or the economy is slowing down. That's important to know. So you really kind of want to think about what's happening in the stock market as well, because there is a direct correlation with things like gold. Now, Ty, we are going to hand over to a couple of questions, but I just want to mention we do have a Telegram group. This is just our one. And if you do want an invite to it, we get asked a little bit. You can just add at Thomas Atkinson, and yeah, we're happy to invite you in there as well. Pepperstone also has a great Telegram group that they've been sending out, so you should definitely look to get that. Some great news in there every day, and it's awesome to see that being updated and everyone getting on Telegram.
Yeah, and I've had a few questions about looking at potential pairs also. That's not what really this webinar is about, but look, I've posted a link in the window for our live market webinars that we do every Wednesday. So anybody who would like to actually get into more in-depth technical analysis on the current live markets, just feel free to click on that link and you can join for next Wednesday's one. And then, yeah, you can basically ask all the questions you like on that one. But yeah, that's more dedicated to live market analysis, is more a teaching one.
Just quickly, Winnie, the green, red, blue lines are moving averages, yes. 20 is the red, 50 is the blue, 200 is the green. Very good moving averages. We explained quite a few webinars back why we use those. So definitely check out Pepperstone YouTube channel and have a look at some of the moving average webinars we've run. Now, two last things, Ty, I want to mention to everybody: create a business plan for your trading strategy. It doesn't matter whether you're trading a commodity, you're trading a currency, you're trading an index. Whenever you're trading, you want to have a business plan, or you want to have a plan that you can stick to and make it a constant thing so that you don't stray, I guess, from your core ideas or core goals. If you wouldn't be putting maybe $100,000 into a business without having a great business plan, or you shouldn't be. And it's the same for trading. You shouldn't be trading a large trade without having a strong business plan. You also want to have risk management strategies. We had questions about this. So you want to be smart with your risk management strategies. You want to say, okay, never risk maybe 1 to 2% of your capital. If you're trading, let's say, gold, US dollar long, then you don't also want to be trading gold versus, let's say, Aussie long and gold versus euro long. Because if you're doing that, you're basically triple risking. They will all probably move in the same, I guess, direction. And if you have taken those trades and then they all go bad, well, guess what? You've just lost potentially 3 to 6% of your account. So you want to be a bit careful there. And I think the other ones are pretty self-explanatory. So, I mean, Ty, what's your thoughts on commodities? I mean, we got into them early. Do you like them? And which ones would you just say are just no-brainers?
Look, the no-brainers you probably worked out. We've absolutely hammered tonight. Gold and oil are definitely our favorites, mainly because they've been very, very technically sound, but also the volatility that people have always been afraid of although it is there on the smaller time frames, and if you are going for very, very small scalps, it can be a little bit volatile. There's no question about that, but no more volatile, I wouldn't have thought, than the pound yen or some of those more exotic pairs. If you're doing reasonable size scalping or swing trading or even longer term trading, they are as good as any other instrument to trade in that regard, and from a technical standpoint and also from a technical bias standpoint. So in our world, we love them. We trade them a lot. and we highly encourage people to add them to their trading arsenal, because quite often when the markets aren't moving favorably in the currency markets, and by that I mean not setting up well and they can be a little bit messy, you do sometimes find that the commodities and indices as well are a lot more stable in those volatile times. So it's really, really good to have them in your arsenal to make sure that you've got those options. If you are well, you need them on your window. You really need to be just identifying them. Highly recommend them.
I'm going to answer this question before we finish up, Ty. It's a great one for everybody. Can you describe a typical kind of trading session for you guys? Looking at your favorite pairs, then potentially seeing an opportunity, trading them, and then just keep looking at the charts and adjust to leave them. How many on average? So it's a great question. So as you open up to more pairs, of course, you will get more trading opportunities. But more importantly, when we're trading, generally what we do is we come in, we do our analysis, half an hour to 45 minutes. We get our bias, we set our alerts, we do not look at the charts unless we're getting an alert. Now, that may sound, you might sit there and say, well, I'm not putting in good efforts and good work. We used to sit in front of the charts 16 hours a day. It is not conducive with good trading. What actually is conducive with good trading is probably coming in, doing the 45 minutes, then going and doing whatever you please to do, and making sure that you do have access, of course, to your mobile and your alerts. And when you're getting alerts, you come back and then you place those trades. Another important one is when you have that trade in the charts and you're actually placing it, once you've made your decision, unless one of the trigger events occurs that makes you need to change your stop loss, take profit, whatever is happening, or break even, etc., you should not be touching that trade. If you constantly are touching trades, constantly taking them out early, unfortunately, it's usually not a recipe for long-term success. So just think about that. Is that business plan attitude that you need to have? So anyway, Ty, look, I think it's a great start to the year. We're very, very happy to be in this new decade. I think it's going to be some great trading opportunities as well. We're already seeing quite a lot of good opportunities over the January period. And we hope this was informative. We always appreciate everyone's feedback. And if you do have topics that you really want, I guess, brought up this year, we are always taking opinions and feedback. So we do appreciate it. And we look forward to seeing everyone in 2 weeks' time for another great, probably I think it's price action based and maybe actually really in the scalping. I think it was, Ty.
Yeah, I think that'll get a lot of people very excited. If you have any questions, just send them through to your Pepperstone account manager. And also, if you have a live account and you want the Smart Tools app, same deal. Just contact them and they'll put you in touch with the link that will do the MT5 version and the MT4 version. It's a very, very useful tool, especially when you are doing some of these more streamlined commodities and indices. Thank you so much for joining us, guys. It's been an absolute pleasure to have you with us, and we look forward to seeing you all in a couple of weeks.
Absolutely. And this will be uploaded to the Pepperstone YouTube channel, so make sure to look at that if you want to rewatch it. See you, everybody. See you in 2 weeks.
Thanks, guys.